Good morning, everyone. Hope you're all safe and well. I'm David Schwartz, President and CEO of FIBA, and I want to welcome you to the first in a series of webinars from our Trade Finance and Working Capital Solutions Committee. This one's entitled Uncovering Supply Chain Finance. As I said, this is the first in a series, and we're looking forward to relaunching, shall we say, our trade committee, which has been a little quiet, but given the pandemic and all the changes and disruptions that have occurred in the supply chain, we felt it's very important to bring to you the issues and potential solutions for the problems that you're facing. We'd like to thank our sponsor, Bank United, for helping in organization of this event. And without any further ado, I see our speakers are turning on their cameras and their microphones so that we can move forward.
Yes,
there we go.
Morning. Thank you.
So without any further ado, let's get started. I'd like to turn it over to our moderator, Shalako Wiener, who's also the chair of FIBA's Trade Finance and Working Capital Solutions Committee. And of course, he comes from our good member bank and sponsor of this event, Bank United. Shalako?
Thank you. Good morning, David and the audience. Here, thank you for FIBA to give this opportunity. We're going to be discussing about uncovering supply chain finance. I have two great speakers with me. So just to give you Oliver Belan, which is the CEO of Calculon, had a great experience working and consulting leading supply chain finance institution. Currently, he started his fintech out of Miami, which is one of the greatest city to be today in that space. And he's going to go through, recently he published one of his book about uncovering supply chain finance, and we're going to go to several points. There is a lot of topics. We can take more than an hour. We're going to try to summarize. And additionally, I have Fabian Fuente, which is a senior underwriter focused on middle market and large corporation. And we have a background in structural commodity trade finance. So let's start. Initially, what is important is the definition of trade. There is a lot of misunderstanding when we talk about trade. We always think that it's only cross-border, but actually it's something simple that any corporation do, and we do in our life. It's just an exchange of goods and services for a payment. So we need to understand that this is not only going outside the US, but also inside the US. So that's critical. And since this crisis of the pandemic, we need to understand more supply chain finance. A lot of corporations are struggling today because of their cash conversion cycle. So what is supply chain finance? And at the end, it's a use of different practices and techniques. And you're going to see different technology that we have today in the market in order to improve the working capital of companies and their liquidity in this complex process. So it's a wide range of products. It's not just one product. A lot of times we think about payables, receivables, ABL. So it's how we use all these products to improve the cash conversion cycle of the corporation. Sometimes we're in a supplier market, sometimes we're in a client market, and that's the way to help companies to grow in a perfect way. So I'm just gonna start with, and this is a roundtable format, as David mentioned, it's the first one of a series that we're gonna do through FIBA. Always focus on working capital and trade finance. So I'm gonna start maybe with Oliver to talk a little bit, an overview of the industry, where we stand and what we're doing, and all the impact that we've seen in the.
Yeah, so I just run Google Trends, which you can see the volume of people looking or searching on the internet. And when you search for supply chain finance, the term supply chain finance, I saw in the last 10 years, the volume of interest and search grew by 400%. So it's not surprising, especially because cash is king, is always king, and especially now. Then we see with the current issues in terms of supply chain disruptions. So a lot of companies now are really looking for ways to reduce or find ways to help suppliers and customers and to reduce these disruptions. And then obviously the introduction of new technologies like financial technology, which makes life easier, which allows new ways of financing, new trigger points. And then obviously the long-term development of moving from letter of credit to open account.
Yeah, I would say that since the pandemic, as financial institution, and we see the government also stepping in, we see that the cash of companies being like struggling. We're more in a supplier market with all this logistic disruption, which is not over. Maybe in the US we don't realize, but the rest of the world is still struggling a lot with human capacity in a way because of the pandemic, and we see all these disruption and getting the ship on time, getting the raw material on time. So we are in a market that if you have the liquidity, you're going to get the raw material to sell it. And then how the financial sector and how banks that always do it for the Fortune 500, but now we see the impact on the middle market, small business, how to convert really quick the receivables in liquidity in order to pay their suppliers. So we used to be more in a client market before the pandemic. Now the suppliers have the power, say they're reducing payment terms, but your clients still want the payment terms. So this has been very interesting time for at least for us that we've been in this industry for more than 20 years, seeing the evolution that today have this kind of product for the financial industry, and we're lucky to have the fintechs as partners in order to open up.
And what we also discussed prior to this webinar is it's not always in bad times. We saw it in the last financial crisis. There was a huge interest, but then you also need to support companies after that for the growth. So it's used in good times, but also in bad times. In terms of, just quickly, in terms of size, maybe you can go quickly back. So obviously the market is huge. There's different figures. Just to show that most people don't realize how big the market is. It's one of the largest, and as I mentioned, is basically the engine for the whole economy, what finance all the goods which we are purchasing from end to end. And what is interesting is mostly on the left side, the combination between the potential and the current. So the estimation is that today only about 10% is really the difference between what is the potential and what is today financed. So there's a huge, still a huge opportunity and gap to finance this type of trade.
No, and that's the interesting part. When we see competition between banks and fintechs in this space, there is no need for competition. So the cake is so big that you have your slide, and the contrary is how we talk a lot about how we interconnect financial institutions, fintech, in order to support this cash that is trapped, that is trillions of dollars that are trapped every year in this cycle from the time you pay your supplier until you collect your client, going through inventory finance and PO finance and ABL. So you have all these structures, but how to manage. And I think one initiative that also FIBA had is open banking. So the bigger challenge, and we're going to see it probably at the end, is how we make this work for everyone in order that we support the economy, the corporation, and have enough business for everyone to do it. So
just maybe one thing in terms of for our audience in Florida. So obviously we are the center of between North America and Latin America, South America. So there's the North, the US, Canada market is quite mature, also the European market, but there's a huge opportunity for South America, for Latin America, and especially with what is going on with electronic invoicing, which again allows more digitalization, more trigger points. So this again, it's the right time to enter into this market to offer this type of financing solution.
I think something interesting on the next slide is how big is the market, because it's not just one industry, and that's why we always go back to the definition of trade. It's just an exchange of goods and services for a payment.
Yes.
So that applies to any industry. Any industry have to pay the supplier, collect from the client, and then financial institutions through fintech, we become, for this middle market, small business, the treasurer, the right hand, in order that they focus on their business and find the right suppliers, find the right client, and do the process of conversion, but not worry so much about the gap that they have in order to turn around their business. So,
and what is also interesting, this is a survey from McKinsey, is you see on the top, the dark blue ones is the investment grade, and then the other one is sub-investment grade, and then unrated. So see, today, the biggest interest is obviously investment grade. Everybody wants to, but the Asian Development Bank, for example, mentioned, like, the financing gap for SMEs, for small, medium-sized enterprises. So we see also now evolution where financial institutions, capital market funders, and also fintechs, they are looking at mid-market or lower rated companies and non-rated companies, because there's, as we said, there's a huge opportunity.
Well, that's the other interesting part, like in terms of risk return, this type of structure is very resilient, and we're going to go later after we review the type of structure with Fabian, how to risk mitigate, how to control that. But the risk return is very interesting in this industry, because at the end, the cost of this go inside the invoices. Mm-hmm. So a lot of data, if you invoice property, this is not kind of a financial debt. This is more simple, and you can embed it on your margin. Really. Yep, yep. So I don't know, Oliver, we want to talk really quick, because we can spend hours on this, about the different kind of structure for supply chain finance that you see, the different opportunity, and where you place yourself on this cycle.
Yeah, so we just as an overview, because again, these are, we can spend hours on just one solution, but if you go on the high level, and this is, we used here, the ICC spent a few years ago a lot of time with experts to defining the market in different solutions. So if you, on a high level, you can separate it between open accounts. So basically, this is the solution where you sell a product and you wait to get paid, and then documentary trade solutions like letter of credit. And then we are focusing now for supply chain finance solutions on open account. And then you can divide it again into focusing on the receivable side, on the payable side, and then others like inventory finance, purchase order financing. Now, on the receivables focus, obviously there's, and look, people have different definitions, but I would just use the official ICC definition. So you have factoring, forfeiting, and then receivables purchasing, and then distribution financing. And then payables, you have the famous approved payables financing, or also called reverse factoring, supplier finance, P cards, and then dynamic discounting. At the end, in the graphic below, what we want to show is it's always between two trading partners. Sometimes an invoice is approved, sometimes not. Sometimes it's one selling to many, or one buying from many parties. And it's always something between trade. You buy an asset, and there's data involved, there's financing, something with risk mitigation involved, and sometimes a funder or a credit insurance is involved, in the fintech. So yeah. This
and that's part of the legwork that I think is critical for financial institutions and fintech, is where we want to be placed in terms of risk management or risk mitigation, and where we add value to the end client at the end. Is sometimes we only do receivables, sometimes we do payables, sometimes it's part of the inventory, and sometimes it's all of the above. So it, depending on the industry or the segment, we're going to place our position in a more I would say secure way for a financial institution, but also thinking where we add value. I don't know if you agree with me, but at the end, what we're seeing on this type of structure is like our major risk in general is fraud, and that's the only way to mitigate that is use your legwork and know who's who, and do your travel, meeting the company, asking questions, because the credit default is very difficult to happen if you have a healthy cycle on that.
Mm-hmm. Yeah, and obviously your relationship as a bank with
and that's where the interconnection, I would say, and where open banking going to add a lot of value on that is because each regional bank, each community bank, or each country bank, they know the relationship, they know their clients, so they know the suppliers. So we don't need to be everywhere to do this kind of business. We just need to partnership with the right fintech, with the right financial institution, and work that together.
Yep.
In that sense, in a way, and I want to jump now to Fabian and discuss a little bit about the risk aspect of what from a perspective, because also we are more in the sell side,
yes.
but how the credit partners in our financial institutions see it, and how would be the right way to analyze, do the underwriting, and put the right mitigants and monitoring down the road, because this demand a lot of monitoring, because companies are living agents, so that they evolve and they grow, they die, they reburn. So Fabian, can you talk us a little bit about the different risk aspect of supply chain finance?
Sure. I just on this slide, I consider to be important factors when looking at deals within this space. I think number one is understanding who is your source of repayment. And these particular factors here, for example, I will just stick to discounting, for example, discounting ARs or APs, PO financing. So on the AR discounting side, I will discount my bars, ARs, and analyze my end debtor or the client, right? On the side of the AP, as you know, we will finance, pay the supplier, and analyze the bar, right? And so liquidity clearly is the most important characteristic here. If you're financing within less than a year up to usually a norm 180 days, and what is the liquidity position of your source of repayment, right? And so within this, I concentrate a great deal, as you know, in the cash conversion cycle. We need to understand the turnover of their ARs, their APs, and their inventory to understand their goods. How does their business model work? How does their good business model work within the industry and the type of good, the type of commodity, right? And so this is something clearly that is one of the most important factors within short-term financing. I talked about short-term funding in line with credit terms. For example, a supplier providing an entity net 30, correct? And through a platform, they're looking for, let's say, 360 days. You want to understand, say, okay, well, look, they're giving you net 30. I think what's more in line with the industry, once again,
Yes.
Net 90, net 120, net 180. So you want to be able to compare what do they have right now versus industry norm, or what you feel comfortable with, right?
So for you, it's very important that we understand what is the regular cycle on an industry, in order not to take a risk above that cash conversion cycle, natural conversion cycle.
Correct. There are players out there, let's say in an industry, will come back to you and say, hey, you know what, the new norm is now 200 days. And so you either work with it or you don't, depending on your appetite, right?
No, and I totally agree. I try to be always conservative in a way that it go out of the natural cycle of what the market demand or what the client need, or even to process their product or their service. Because also you have to take into consideration that you pay your suppliers, but then you have a period to build something or prepare a service, and then go out and sell it, and you have certain payment term from the client, because they all have their cycle. So well, that's the beauty of supply chain, that everything is interconnected. But I agree with you that when you push longer terms that doesn't go with the industry, is where you borderline taking a risk that you shouldn't.
Sure. The debt structure of your source of repayment is also important. What I look at is that the entity has a low short-term debt obligation. You see companies out there, especially the publicly traded companies, where they will have billions in debt, but these are senior notes that are due out 5, 6, 10 years. So what I look at clearly is what are their debt obligations over the year, 360 days, correct? To me, that's very important. Access to capital markets. once again, if you are a small, an SME, middle market company, you probably won't have access to capital market. But if you're a publicly traded, clearly you do. What I look at here is what is their availability? Do they have bank lines? Do they have revolvers? What are the availability under their revolvers? I look at that also as an important flag.
Mhm.
I think when we look at smaller companies, clearly access to capital markets is probably nil. But what I concentrate on there is now I need to understand who their suppliers are, what type of trade references I can obtain, how is that particular industry doing? Because clearly for the larger companies, publicly traded, information is available every day. But with the smaller private companies, clearly if you're asking for financials today for June 30th, so many things have already happened. So on that side, monitoring the industry and obtaining information from vendors. You spoke about, remember, on the credit insurance, where you want credit insurance entities to start sharing information, correct? Similar to what D&B does, where they obtain trade references and then they sell it out there. Because you can't guide yourself on financials because they're already old. You want to know how they're doing from the point of view of vendors.
And that you have a good point, and I think that interconnect with what we're seeing with the fintechs today. So the capacity to have this fintech connected to your system and have real-time information, that I think is going to be more and more critical for an underwriting point of view. As you mentioned, when we see all this facility, ABL facility, like traditional type of finance in work capital, you always get late the information. I think that today with blockchain technology, artificial intelligence, and maybe something that Oliver can talk more about, is like, I think we get into a moment that our credit guy, our credit team can have real-time vision on the liquidity, on where is the financial strain or challenges that a company can have, and where we can add value as a financial partner for these companies. So do you agree on that?
Yes, something that comes to mind real time is within the oil industry, you have a crack spread, C-R-A-C-K, crack, and that allows you to actually monitor the gross profit margin of an entity, and it basically takes into account. It's a formula. It's online, crack spread. It's a combination of oil, gas, and diesel, and it comes up with a margin, and it gives you a very good indicator of how a oil-related entity can be producing. So those are real time information. You can guide yourself. In terms of mitigants, one of the most important things here, once again, liquidity metrics. Be able to, once again, if it's a large entity, publicly traded, you're able to do this on a quarterly basis, okay? As opposed to a smaller company. But the typical standard working capital current ratio and availability of bank lines are very important to me. Uncommitted facilities, I think that is something beautiful to have, quite honestly. I prefer to have uncommitted facilities. That's, once again, my target is not to go in long term. And when you see red flags out there, signs of problems in the industry, company, industry, and so forth, you're able to say, okay, I'm going to stop. Let me reassess my source of repayment and go from there. During the start of the pandemic, many entities in the restaurant business, we started noticing they were closing stores, restaurant stores, coffee related entities closing their stores. So those are indicators. I'm not saying that we should all of a sudden be alarmed, but clearly these are indicators that operational indicators that also help to look at. Like I said, ability to stop funding in the event of problems from the point of view of your source of repayment, problems in the industry, and so forth. I always say that within credit, it's an art and science, and there are a lot of intangibles that have to be considered.
No, and I think that everything that you mentioned and the way you mitigate and monitor all that, there's something that probably discuss of the importance today on the relationship with the fintechs and the FIs. So I think that's where we're going to see a critical evolution on that, because it's going to bring at the end to the portfolio management, to underwriting, the tools that probably we didn't have in the past, and that way now we see this booming, and probably we can talk about so many platforms, so many different artificial intelligence. Everyone is focused how we're going to handle this trade monster and financial that is there and that we needed, and the market needed more than ever since the disruption that the pandemic created. And so can you talk a bit about this fintech evolution?
Yeah.
And
It's just what I want to show the key messages. This comes often is like fintech will not replace banks. That's the key. But this is just these figures. You don't have to take them like they're not super accurate, but it's a trend. It's some of the financial technologies, information, data streams which were before provided by banks are now being specialized and provided by financial technology. However, one key aspect which I think for the long term or forever will not go away is the relationship between the bank and its client, and the who is taking the risk. So if the bank or any credit insurance, so analyzing the risk and provide lending. So this will never go away. Fintech will just provide additional services to help being more efficient.
And that's interesting, because my experience has been always a banker, never worked in a fintech, but I partnership with other fintechs. Like, we need to rebalance in a way of relationship. Banks were heading to be IT companies, and now we understand that the most important is relationship. We're in a business of trust.
Yes.
And our clients, how we bring and add value, not just provide like digital information, which in banks tend to be always behind the truck in terms of technology. What is awesome with fintechs is like the cost of technology is going down. The capacity to develop new tools is getting very accessible, and it's kind of worldwide. You can have your teams designing your software engineer around the world, and then bring a tool that is worldwide. Banks will still very regional, very focused on our client, because we're a trust business. Mm-hmm. Even though everything is digital wallet, digital banking, I think the human being still, when it's related to their money, have this interaction with financial institutions. So I think I agree with you that we're going to need to balance that synergy. I don't see as a competition, but as a complement.
Yes.
And bring the best of the two worlds in order to benefit at the end our clients. So that's, I think it's very interesting, and looking forward what's kind of next. But how we start, financial institutions struggle a lot on this partnership with fintechs.
Yeah.
So what is a little bit your vision, how banks can participate with fintech, and which
yeah, so I think this slide is important because there's a lot of, obviously through FIBA, a lot of their members and other parties provide, most probably financial institutions interested in this topic. It's why you are today in this webinar. And the question is, okay, I like what I hear in terms of the risk perspective, in terms of the technology, the opportunity. So how can I start? This question always comes up. And I saw that during the last 10, 15 years, it's always the same pattern. So first of all, if you see an interest, then I would always work with a bank, speak with your banking partners, and see who has already a program, who is already providing financing and offering risk mitigation to some of their clients, and ask them if they have assets to sell. So basically you participate in an existing program with one of your banking partners. This is an easy way to get into the business without having to do sales, operations, integrations, knowing a lot about IT, etc. and you can still have access to this great risk return profile, which we discussed before, but you don't have, obviously, you don't have maybe the relationship with the bank, but you can participate and you can learn. And the next step is, I would say, is to work, and it doesn't have to be either or. Mostly you see banks, they have all three stages at the same time. Probably your bank also has the same. So the next step is where you select one or two. There are banks that they work with 5 different fintech platforms, depending on what the client wants. Now, if the client wants to work with a bank, they work with a bank. If they want to work with a fintech platform, then a lot of banks are willing to work with these platforms. And there, obviously, you need to integrate with the platform. You need to do your homework on legal, on the structure, on many other aspects, which it takes more time, but you are more at the driver's seat. You can more influence. You also have much more access to client relationship. The last steps, and there's only a few banks which did these last steps, is basically where you decide to develop your own platform. And there are some good and some bad examples on that. Mostly when you start as a bank, when you finish, you're already 10 years behind. But yeah, the good thing with the last aspect, you control everything. Because we always speak about fintech is great, but there's also risk. You're depending on a third party. So the last aspect is, yeah, you control everything from platform, the user experience. But this, I only know a few multinational commercial banks which are doing so, and it's not only the platform. You need a whole team support, integrate. It's a huge undertaking. So
yeah, I mean, through the years, through professional career, I've always been trying to just partnership, but with different platforms in order to cover the risk, the operational risk. Because fintechs that were here, they're no longer here. They changed the business model. So in order to mitigate my risk in a way, but also all the transactional part, keep it in the bank. So in order that the fintech become a tool, but not part of all the transactional part. And those partnerships through the years have been very great and positive to have. And as you mentioned, it's more efficient than developing technology internally. I think when you reach out a critical mass, like maybe the top 5 banks in the US, then it's like, okay, now is the time to invest on that, because you have enough volume to justify the investment.
But also a lot of multinational corporates, they have, obviously, what you speak today, supply chain or global. So even the most international bank cannot be in every market.
That's correct.
And the corporates know that, and they have also local relationships. So how then, this whole multi-banking aspect. So either the bank, which on the last step has its own platform, either they're also willing to open and other banks want to collaborate with other banks, or you work with a fintech which is totally independent. So it's yeah,
and I think that's going to be, if we're talking a little bit what next, or what's coming, well, we'll still go to the different areas when you implement this program, but what is coming is that interaction. But there's still certain point that when you implement a supply chain financing, you need to take in consideration in order to be winning on when you implement it. So
yeah, so this everything sounds great, but when you look at some of these existing programs, sometimes they have not achieved what they should do. And I just put here a few reasons. I would say, first of all, you need to do your homework as a bank or fintech to go after the right prospect. So in terms of what is a good candidate, a good company, in terms of risk, but also interest, then also who is the right persona to sell it to. Obviously, it's a treasurer, which is focusing on cash flow, working capital improvement. But then if you look at the payables financing, you have to involve the procurement team, because without that, it doesn't work. So you really have to do your homework and find out who you should go after. And then within the company, there should be alignment between the management that they really want to do it. If not, it's a waste of time. Then you have to find out what is the legal structure in specific countries that you can perfect your interest. Then the accounting treatment, this is a whole other topic. And then, as we discussed before, do you want to do it yourself? Who is the right partner to work with in terms of banks or fintech? And then the whole onboarding. piece, which you can also spend 1 hour, KYC, ML, compliance. And then the last part, I just want to focus, it's close to my heart, the blue ones is what we discussed before, is the analysis of, once you have a program, you have to find out what are the right payment terms. You mentioned before, when you look at if this is not industry specific. So this is what we did at Calculum, where we analyzed portfolios, we found out how to optimize these terms, what should be the right terms, and how to negotiate these terms then with your trading partners. And then also to finding out who is the right candidate which will use this type of financing. And once you have, at the end, data is really key to make this program successful, to start, but then growing these programs.
Yeah, no, and definitely that's what I see, that sometimes it seems very complex because there is many factors, but at the end it's the day-to-day business of a treasurer. And when you bring this solution to a treasurer, like they open and say, well, nobody ever offered me that before, and I'm struggling here with reconciliation, analysis of my suppliers, all that, and then they understand the added value. I think a lot of the legwork is on the implementation, but the one these programs are turning is very smooth when you have the right team, the right monitoring, all that is, I would say the struggles at the beginning, but then it's so smooth and they love it. So and then the relationship is stick with you. One day they go and they do the investment, and then that relationship is stick.
Yeah, maybe we forgot what, you know, when you said before in terms of what you like, uncommitted and short-term financing, but one of the key points is you're embedded in the supply chain. These programs, I know, they are since 10 years, 15 years in place. They never end up, because once you give financing, everybody is depending on it, and the supply chain is moving all the time.
And I think, Fabian, maybe from your side, from a risk perspective, that interaction with the client, and you see in different programs that we have, is like almost on a weekly basis. So you don't land and don't see the treasurer or the company for a year or 6 months later.
Continuous communication. Yes.
So you're being experienced that
yes.
This create a good interaction between risk and the client.
Right. We have. I noticed we have legal documentation to the left of medium. To me, in these structures, legal docs are clearly important. But do you have it to the left of medium simply because once you have a template of a particular, financing, you're set? Is that why?
Yeah, I mean, look, this is just my view, but there's different legal structures. But once you selected the right one, then
correct.
I mean,
you know, master participation agreement.
Yes, or an RPA, and then you find your, it's not so complex. The more complex is based on the legal structure to find out where's your risk, like a massive purchase. Suddenly you have also the risk of the other bank who's selling your assets. So but I think the legal structure right now, after so many years of having this problem in place, there's quite some standards which you can download.
Right, like it is though.
Yeah, exactly.
Right.
I think where is the big challenge, and one name, but where we've seen a lot of the failure in this industry has been more on the monetary side. And that's where it's so critical to have the fintechs to help on that, in order to have the tools in real time. So what is next? Where we going? Where do you see that is gonna go this industry?
Yeah, so obviously in some markets where the saturation or the markets are already mature, they still, all these programs, large programs, they just scratch the surface. There's a huge opportunity to grow these programs. Because they're just focusing today still on the top suppliers or top trading partners, but there's the famous tail, the smaller, and they are in need of financing, and they're mostly not included in this financing part. So again, here, fintech can help to make it more efficient, but we're still at the early stage. Then what we discussed before, when we look at the different supply chain finance structures, today clients, I see more and more, they don't want one solution. They want a solution to their challenge, but then you have to provide a holistic. You have to say, okay, for you, I will provide a P-card program. For you, a receivables finance. It's not just one solution fits all their needs.
Yeah, and from a practice leader on that, that's what I see the most challenge when you deal with financial institutions, that when you try to promote working capital solution, at the end it's not one solution, and at the end like that. But on the other hand, you become very close to treasury management, and then you have all these products that the financial institutions love, like they are more like a fee income, is like those treasury management services, but you are in the core business. I always say that I'm very passionate about my practice because I become the blood of the company.
Or you become the consultant of the treasury. We help them.
And again, it's a different product. It's how do you put it all together, and it is like when you have to do your magic and partnership with the right people. I think artificial intelligence, and maybe you can talk a little bit about it, that's going to help a lot on this. It's kind of monitoring, analysis, and improve.
Yeah, so AI, for example, plays also when we look at the mid-market, so again, the top Fortune 500 companies, they all have supply chain finance solutions in place, but mid-market, so they also have a big need. The risk maybe is a little bit different, but the returns are higher. So here also AI, or like, how to help the credit analysis world, like to score or to find better pricing and still offer them supply chain financing. And then just one thing is what we see more and more is partnerships. So now networks are being set up where the last 5 years, the first time I see where really banks are working together and are opening up banks with fintechs, and fintechs with fintechs. So that is great. And now speaking about new technologies, obviously digitalization is key. It's key for AI, machine learning, because you need to feed them with digital data, and then blockchain also. If you don't have everything digital, then blockchain is not ready for that. So
and that's important. I think that organization like FIBA that is working up in banking, but also I think from the trade perspective, organization like FIBA or others, is like we need to start pushing more that digital world. It's like we still use paper BLs, so bill of lading, that paper doesn't help. Invoices, I know a lot of countries like maybe Colombia, and you can talk about Mexico, they're moving to electronic invoices.
Yes.
And in Europe also there is a big push for electronic invoices, and then that's going to be able to standardize, and if you can add some blockchain technology, then you have to protect the financial institution or the shadow bankers in order to avoid fraud. Because what we see in the past, like an invoice can be sold 3 times, and say, well, because it's just a paper. But now when it's digital, it gets more difficult, and you have the traceability. So I think that a lot of organizations need to push the digital world on this negotiable instrument at the end.
I agree. But as a summary, I think, look, in terms of the new trends, it's a very fascinating market. Things are moving. It's a very old market. It's hundreds of years old, but now suddenly there's a strong interest and a huge development.
I would say like supply chain finance was invented by the Medicis in Milan, Italy. That someone had an idea or a product to build, someone want to buy it, but they were in the middle, say, I have the money in order to make you the product and you pay. The good part on the time that we don't have anymore, that the consequences were really dramatic, that if you don't get paid to the medicine fund. Saying that, Oliver, I know you moved pretty recently to Miami,
Yes.
and well, you write the book that I totally recommend. I think it's it gives you the 101 that you need to know about supply chain. It's your second book, but also you launched your fintechs, How to Miami. Why Miami? What you see in Miami, and what's going on? I would say Miami or Florida in general.
Sure.
It's been very interesting for you.
I think everybody can agree, and FIBA is, and to be honest, I didn't know that before I moved here, but Miami is the second largest financial hub in the US, after New York.
Yeah.
So and it's between North America and South America. So if you want to do business trade in terms of with Latin America, South America, this is the key. And now what is happening with COVID, it's a huge boom in terms of fintech, not just startups moving here, but also money, venture capital investing here. So it's a right place to be. Again, I think trade finance, supply chain finance in Miami is really fascinating right now.
And I love it. I've been a banker in Miami for many years, and I have to travel abroad in order to find this fintech. So finally, I started getting here locally, and That's great. I need to reduce expenses and travel. So I would like to thank you, both of you, and I want to open the floor to question. I don't know if Tanya, did you get a question during the thing? I'm getting old and I cannot see very well, but
Make it bigger.
oh, David.
Ilaco, there are several questions in the chat. I don't know if you've had a chance to look at them. If not, I can read them for you and we
Yeah,
can
if you
take
can
them
read
one
it
at a
for
time.
me, David, that will help.
Sure.
A little-
Okay, the first one, can you elaborate on e-invoicing and the electronic registry like ICC filing that is now automated via the DIAN and RADIAN in Colombia? Is this a trend around the world?
You want to go?
Yeah, I mean, just quickly, just about the trends. So it's like what Mexico, Colombia, what they achieve in terms of capturing more taxes, and you know, and seeing the whole flow now. It's, I think Turkey has just implemented it. Saudi Arabia is implementing it this year. Spain is looking at. So this is now being implemented in many countries, and Latin America was one of the first regions which started that.
No, I would say that the trend, because I've close relationship with one of the lawyers that pushed that in Colombia. I think there is to think about invoicing, always transparency, and David, maybe you can talk a little bit about open banking. And the other thing is that the world start getting super connected. So we need that trend. I don't see it yet in the US. I think the private sector or the institution have to push it for that. I don't see the regulator pushing on that way, or the market accepting, but yeah, definitely something that is going to come as a standard in the industry, and SWIFT is doing a good job on that way.
Great. Yeah, I mean, as far as open banking in the US, as we know, the US is regulation challenged in the sense that we're able to put out a lot of regulation when it comes to anti-money laundering and anti-terrorist financing. When it comes to the innovative technologies, they're struggling with putting this together. Hopefully, now with the mandate under the Anti-Money Laundering Act of 2020 that obligates FinCEN to start analyzing innovation and technology, creating subcommittees to discuss it, creating a symposium around it, that maybe we'll finally have a push forward in the US. Next question, regarding what is the norm regarding retail where there is negative working capital. So you don't know what you are financing anymore. How do you deal with that?
Yeah, retail is very interesting. I would say retail is one of those that you're probably going to focus more on the payable side than in the receivable side. In general, you see a lot of these large retailers pushing a lot of pressure in their suppliers, extending payment term, even though they collect right away. So you have that negative impact. And it's where you can step in order to protect those suppliers in order that they get the liquidity right away when they perform. What we've seen lately is like retailers are protecting more and more their key suppliers, but the others struggle because, you know, when you put that pressure in their liquidity, a lot of companies, they don't have the right structure, they cannot resist that pressure from the big retailer.
And yeah, I agree. And this is related to another question about ESG, if this can be implemented on the famous economic social governance. So I think this is it's a new trend. It's not, no, the last 10 years, like, as you mentioned, like companies extend payment terms and more and more, each industry goes higher and higher. But now we see that some companies are doing the opposite. They see that this cannot go on and on. So you need to support some suppliers, minority suppliers, which have, which are performing well in terms of social, economic, or like governance in general, and there you can offer different financing rates based on their ESG ratings.
I don't see the retail changing the way they work, but I see that there is solution to support their supplier, and more with the, as you mentioned, all the ACG,
Mhm.
it's going to become more relevant than ever supply chain finance.
Okay, next one. How is the bank treating COVID-19 related debt, short or long?
Oh, that's is a little out of my scope, but I don't know.
Is that the PPP? I guess the PPP
Yeah,
loans, as a result of COVID?
Well, I think that would be one aspect of it.
Oh, that's regarding the PPPs. Clearly, the amount that is extended depends on the capitalization of the company. Can it absorb? You need to say, can it absorb additional debt? And once again, this is, if I'm not mistaken, this is really a capital injection because these amounts are forgiven, and so that's free money. That's the way it should be looked at.
Yeah,
It's a capital injection.
So yeah, it's a capital. I agree with Fabian. It's going to be treated as capital injection when it gets forgiven.
The next one's actually a comment. Make or buy is always the question. Developing something that already exists is a waste of time. Better to become a good integrator of existing mainstream solutions and spend the IT budget on innovation and co-create with fintechs to solve client problems that are still on the table. My 2 cents.
But I totally agree. And again, being a banker for more than 20 years, I always push that do not develop what is already on the market and get the best player outside instead of do that and focus more on relationship management. I always been focused on my relationship. And I think that's where people are looking from the bank is how you take care of your clients and how you support their needs. You don't need to create every product if it's already there, but you need to guide and manage in the way that they need. I think corporate bankers, which I am, we little by little we tend to be more like a private banker. Let's understand your business. How we can help you in order to grow your wealth and grow in a healthy way. I always say that companies that grow too fast, they run out of cash and they get in trouble. So it doesn't seem like, oh, this is a great company because it's growing. No, it's how you grow and the pace and that's where corporate bankers, we need to do more of the legwork and not just push product. Let's understand the problem, find a solution, and see if we don't have internal, how we partnership with the fintech to bring it to the table. So totally agree with that comment.
Okay, next one. As the corporate world is still just moving to a digital with e-invoicing, etc., how realistic is it to believe that DLT is going to be embraced and used already, or is it still at least 10 years out? What is your view on a fully DLT finance world? When will it really happen?
You want to know?
So everybody has its own view, but I think it has a huge potential. Right now, to be honest, if you look, the positive thing is it has changed the mindset. It opened up, especially between financial institutions, to work together, because you can only master or deploy DLT, and the power is with different players, market players, and so you have to collaborate.
Yeah.
That if you are only yourself, then you don't need DLT. What I want to say. Right. So it works kind of a network setup, and especially because it's a new technology. Companies which apply this new technology, they have to learn. So they have to also share experiences and best practices. So this has changed a lot. I see it where banks are really working together and trying to implement that.
Yeah, my 2 cents of that, I think, is the private sector that have to push for it because the need is there. I don't see the regulator moving on that direction. I think the private sector is going to build it, we're going to deploy it, and with all the participation between the corporate, the financial, and the fintech, then the regulator is going to step in, okay, when the market is created. Not very different what happened with crypto. Like crypto is totally deployed and everyone is using it. Now the regulator, okay, let me look at it and see. So I see the same thing happening with all this.
But to give an answer like where we are today, currently today, and I speak with a lot of banks and fintechs which are very engaged and have managing a lot of assets and volume in supply chain finance, they are not using it. So these are new concepts, new players, and if it works and if they're used, then yes. But right now, today, the status is the key players are not using it.
I think there is a big human factor on that. I think
Yes,
we still attached to the paper, and people think that they can lose their job if they move to all the digital world. But it's just your use of time today can be better put at use in these companies and develop more better the business than just managing still in paper. So I think it's you know, humans, we tend not to go to innovation until we see, oh, it worked for everyone. Like, so it's like we used to have a phone, a landline at home, still that nobody used it. Everyone used their cell phone, but we want the landline. So I think it's an evolution that is coming. I agree with you. It's not fully deployed. I don't think it's going to take us 10 years. I think with the pandemic impact, we're going to see this more and more happening, and maybe 2 to 5 years right now.
Yeah. But will this be another small bank, big bank issue? You know, is it going to be a challenge? And we're seeing it now with the innovative technologies that the smaller banks don't have the resources, and resources, when I say resources, I'm talking not just money, but personnel that understand how this works.
And that's, I think Oliver's been saying through the webinar over and over, that's where is key the collaboration. That's where the key organization like FIBA, our committee, the fintech world, and bringing a little bit also our credit partners. I think that's why I invited Fabian to this. I think our credit partners and risk management need to understand more this evolution of technology in order that we fully deploy more aggressively.
But maybe, David, it's interesting what you mentioned. What I saw in the past, that, and what I just said, the big players in the market, which move and finance billions of dollars today in supply chain finance, they're not currently not using this blockchain type of solutions right now. They're investigating, but right now, what is finance? No. But what is interesting is the smaller players or banks in emerging markets, they are very interested, and probably this would be the same, like, you know, in some emerging markets with the landline to come back, and the phone, the mobile phones, they never use landlines. They went directly to mobile phones, and maybe with this regional banks or smaller banks or in emerging markets, they start supply chain finance maybe with based on DLT. They will never start where we are today. Could be. But
no, I like your analogy, because I remember, I'm going to date myself, but I won't mention the year, traveling to Argentina, when here in the US, you know, getting a cell phone was still a novelty. And yet I check into my hotel in Buenos Aires, and you have the body of the cell phone there on the desk saying, go down to the concierge if you want to lease this phone, and they'll give you the rest of the phone, the battery, and charge you, you know, $1, you know, a minute. And nobody had landlines, as you said, because it was easier and cheaper and took much less time to get a cell phone than a landline. So I think you're right. I think the banks that are able to adapt much more quickly will be the smaller ones. The big ones always think, well, we have the market, so why do we have to change? Right. And that's going to be their mistake.
Yep, totally agree.
Well, here's an interesting, I like this one. What do you think can be the mainstream of using cryptocurrency as a currency to buy AR invoices in supply chain finance?
Well, you know, crypto is a big challenge, I would say, today on the regulatory, and we see what is going on in Salvador, for example. So yeah, it would be great to have crypto in trade, or have. I always think that if we are able to build this huge portfolio of trade finance, because the only thing to financial institutions, I have a lot of private investors that always call me and say, I want to invest in supply chain finance, family offices, hedge fund. because they want to build this portfolio because first, it's a very secure business. You know where you're financing. It's not like this type of product that you can buy in Wall Street, you never know what is behind this.
Yes.
Supply chain finance, you know, there is a supplier, there is a client. So, and a lot of these kind of, because I have this meeting, as Oliver mentioned, Miami is becoming like a capital of fintech, and you know, all the crypto companies that are in Miami, a lot of them approach me and say, can we tokenize supply chain finance? So, and I say, we're not there yet, because we are not able yet to interconnect and create this portfolio that then can be tokenized and create a crypto based on supply chain. But I'm pretty sure that a lot of them that are listening, they're watching, because I receive a lot of calls and probably Oliver too. It's going to happen. I'm pretty sure we're going to have a cryptocurrency at any moment on trade finance, and probably going to come more faster from Asia than in the US.
The question is, and by the way, I think the mayor, he launched just a few months ago that you can pay your taxes in Miami based on crypto. So, but I say, I mean, the question is, when the financing comes based on the cryptocurrency, is the actual physical flow of trade between a buyer and a supplier, will it also be? I mean, I think this has to be first based on Bitcoin or a cryptocurrency, and then the financing from a bank. But
I say more the investment side is going to be looking at that. So the financial institution, the fintech, we're going to create the volume, and then investors going to start doing the.
But then the suppliers, or basically, the suppliers will be financed in crypto, or then in a.
That's a good question.
Yeah, so I think it's still early stage. I mean, very early stage.
I don't see it happening at least this year.
Right. Yeah, well, we'll see. And, following up, it's interesting if you saw the announcement that Silicon Valley Bank is now opening an office in Miami. And that's, part of this move and the focus of Miami on the fintech and innovation sector. So it'll be interesting to see if that brings any type of change in how the market approaches this. Because as we know, banks are still a little bit wary of engaging, but now we get a new player in the market. It'll be interesting to see if there are any changes, because of course they're talking that not only do they provide private banking or wealth management, but commercial banking to these technology companies. So it's going to be very interesting to see.
Interesting that you mentioned that moving from Silicon Valley to Miami, because now we're getting all the brains that we need and all the different industries inside of Miami or Florida in general. So the interaction is going to be very interesting on what we can do together. If we understand that we need to collaborate together. And I think that could be an interesting platform for that discussion.
Yeah, FIBA can play an important role in that.
Absolutely.
I think we're running out of time. I don't know if you have another question or not.
Yeah, we've run up against the clock, as we always do. So thank you, Shalako, Alvaro, for I'm reading the unfortunately the names that are on the icons for Zoom. Excuse me, Fabian. Thank you all for your insights. I think it was a very interesting discussion, and of course, more to come. This is an evolving situation. It's an evolving ecosystem, and I'm sure we'll be talking more about what we can do, particularly here in South Florida, with all of the moves in innovation. Thank you again, Bank United, for sponsoring the conversation. Greatly appreciated. And we look forward to more collaborations in the future. And thank you, people, for great questions that you put out there. And we had some good answers for you, which is always nice. So look for future webinars in this series. We'll continue our conversations on the supply chain and innovation and where we're going. Remember, FIBA does have an open banking platform and initiative, which you can join. It's complimentary right now. So go to FIBA Open Banking and you can register there and see all of the other webinars, events, information, white papers that we have there on the variety of topics related to open banking. And more importantly, well, the numbers are coming down a little bit in Florida. I think we cut them in half in terms of number of new cases, but please be careful out there, stay safe, wear your mask, social distance, keep washing those hands so that, we can do this in person. I really would have loved to have done this event in person. We could have done a nice book signing with Oliver, but unfortunately, those limitations are there, and at least we were able to do this virtually. So thanks again.
We'll do the
Shalako.
in another occasion when we can meet together.
Absolutely. So thank you all again, and we'll see you soon.
Thank you. Bye-bye.